Good afternoon, everyone, and welcome to the latest Built Environment Networking webinar. We are very, very pleased today to be joined by the Cornerstone team, David Hanna, who I will introduce more formally in a few moments. And the theme of today's webinar is stamp duty land tax, and we're here to explain the complex nature, reliefs and refunds. And we're very, very proud to have Cornerstone as one of our core partners here at Built Environment Networking. My name's Matt Christie. I'm your host for today. I'll be kind of navigating the choppy waters of everything that David's going to be saying as he simplifies everything for our audience. And I'm really pleased to say that there are over 70 people logged on taking part in this event today, which is superb. Just a quick overview. In 2020, we ran over 320 online events. That's quite amazing for an organisation that before March, before the pandemic hit, was only really doing physical events in towns and cities across the land. And we've had a very, very busy start to 2021. This is our 73rd webinar, many different sectors, many different topics, already over 10,000 unique viewers in 2021. And before I start, I would like to, say thank you to our national partners who you can see on the screen right there in front of you. We've got Wilmot Dixon, Newformer, CLS, Pagabo, Cypro, SPC, View City, Lead Associates, Langley Roofing Systems, Barber ABI, Recoup Capital and Butler in Young. And obviously also to Cornerstone, who are going to be taking us through this today. First of all, a little bit of housekeeping. It's very, very important that you edit your profile so that everyone knows who you are when you're asking questions. And more importantly, for the networking afterwards, when we're going to be having a relaxed discussion about everything that we've talked through here. David and his colleagues will be in the networking room to have a chat. And my colleague Pete Colley's also in there. So the way that you do that is if you can see the photo icon at the top right-hand side of your screen, you can click the drop-down menu, you can click on the edit profile. You can add a photo if you want to, or maybe not. If you've got a lockdown haircut like I have, it might not be a good idea. And you can also add the name of your company. The best way to do that is to put your full name in the first name box, as it says in the main stage. My colleague Nick Robertson's there. And then in the surname box, if you want to insert the title of your company, so that we all know who you are. You can also, double click on people, chat with them, arrange a video call in the networking separately after this session, and just generally, navigate our technology. We're living in a virtual world, and we will be, I think, forever now, even though everything seems to be getting better with the global pandemic. Finally, just on the right-hand side, if you would like to pick David's brains throughout this session, you can leave a chat in the event chat. So there's two tabs, there's event and main stage. Please leave your questions for David in the event chat. And I will do my best to kind of, pick them up. In the main stage chat, and I will do my best to pick them up. Also hovering around that main stage chat's James Morley, who's one of David's colleagues, and he'll be able to answer any questions as well, should David not get round to it. So, onto today's webinar with all of that, which, like I said, explores stamp duty land tax, explaining the complex nature of reliefs and refunds. We're going to be looking at the new 2% stamp duty land tax on non-resident surcharge. UK companies, are you affected by the changes? Individuals who regularly travel abroad, how are you going to be treated? How mixed use and multiple dwellings could save you money? Plus, we'll update you on multiple dwellings relief and refunds, where we'll discuss if you're eligible. So without further ado, I'm going to hand over to David. I will disappear and I will be back when David's finished to ask some questions. So over to you, David. Looking forward to this.
Thank you, Matt. Could you possibly give me the ability to share my screen, please? And then I should be able to put up some reasonable content, because nobody wants to stare at me for a full hour.
Okay, give me 2 seconds, David. I was unsure that you were going to be doing that, so let me.
No problem. And we have a degree of control.
Okay. Can you do it now?
Let's see. I'm sharing now. Can you see that, everybody?
Yes, we can. Yes.
Lovely, cracking on. So good morning, everybody, and thank you to BEN for the invitation to talk this morning. As Matt has already said, we're going to talk a little bit about refunds, a little bit about 2% surcharge and the complex interactions of that with the 49 reliefs that there are for SDLT. Little bit about us. If you don't know us, we were formed in 2006. We're chartered tax advisors. Surprisingly, we specialise in SDLT, given the title of this webinar, and we provide a full comprehensive professional service. We can do what's called a post-completion health check, or in other words, looking to see whether you're eligible for a refund. We're fully backed. Professional indemnity insurance is required by the CIOT, 1.5 million any single claim. And we've done a fair bit of these as well, not as many as BEM, but this is getting to be the new way to talk to people. So we shall see. So let's just remind ourselves where we are. Stamp duty, land tax. And it annoys me because it was introduced in 2003 and it replaced the old stamp duty, which of course was a duty on documents. Unfortunately, they retained the word stamp duty in the name of the new self-assessment tax. And that has led to a lot of confusion, not least amongst solicitors who still think it's a duty on documents, but it's not. It's complex. It's probably had more changes than any other tax I've been involved in 40 years. Key, it applies to all acquisitions of residential and non-residential land and property interests in the United Kingdom, including beneficial interests. So even if there's no transfer of legal title, there's no TR1, no conveyancing, the tax can still apply in some circumstances. And of course, these days, because of the plethora of surcharges and everything else, we now have to look at the type of property, because that's fundamental to whether or not you may or may not pay residential surcharge or non-residential surcharge. We have to look at who you are as a purchaser. We have to look at the number of dwellings you already own and whether you're replacing your main residence. And last and not least, look at the nature of the consideration provided and whether or not it's connected party. And all of those are deeply relevant to calculating stamp duty. What surprises a lot of people is you can have multiple rates for the same property, depending on what the property is and who you are. And I'll get to that when we talk about multiple dwellings relief in a bit more detail. The issue we have is that the people we leave, I would say, ordinarily, we expect our solicitor just to do our SDLT return. We think it's an administrative thing. We've all used HMRC's calculator, got a figure in our head. The solicitor's given us roughly the same figure on the draft completion statement. And it kind of goes under the radar that maybe those numbers are wrong, because you wouldn't be expected to be a tax expert, but neither is your solicitor, unless, of course, you employ an expert tax solicitor. But there's a very good chance that there'll be something in that transaction which could reduce that liability because there's a relief or a connected party, and you shouldn't really expect your solicitor to deal with it. Our argument is always go and get advice. So where are we today? Well, we've had a holiday, at least from SDLT. None of us have had a holiday anywhere else recently. We now have an extended SDLT holiday to the 30th of June, and then we have a slow return to normal with a phase down of the holiday up to the 30th of September, and then back to normal, which is good. But it does mean that literally moving a transaction one day may or may not get you the benefit of all or any of the holiday. And of course, we have to add 3% onto those rates for second homes. And now we have to add on 2% if you don't meet the residency test and are deemed to be non-resident. And what that can mean is that an expensive property, residential property, could now cost you 17%. I'm old enough to remember when VAT was less than that. So it's quite stinging, and people should need to take a lot of care making sure that they should or should not pay these surcharges. And if you compare and contrast those rates to the rates below, which are the mixed use or commercial rates, you can see that there actually is a fully up to 12% difference between the rate of tax for mixed use and the rate of the fully surcharged, I'll call it, rate for residential property. And that's a lot of money. That could be a significant amount. And this is perhaps, I think, one of the things that kind of slid by with the budget is that we had this new 2% surcharge. It's called a non-resident surcharge, but in actual fact, it could apply to UK residents, and it could particularly apply to UK companies. And I'll get into that again in some depth in a couple of minutes. Even mixed use multiple dwellings claims, which are exempt from the 3% additional surcharge, are caught by the 2% surcharge. It was at this stage of reading the legislation, I felt the temptation to go and lie down in a dark room with a wet towel over my head, preferably with a bottle of scotch. Unfortunately, it was only 9:30 in the morning, so I couldn't get away with a bottle of scotch. But you almost have to now consider the 2% surcharge as a separate tax that happens to apply to your property transaction, because its rules are bizarre and arcane, as you'll see. It's still, however, to think about doing multiple dwellings relief claims on permitted development conversion sites, because essentially, if you are a non-resident, you've just pushed your minimum rate up to 3, which is still less than the 5 you would pay on the commercial rate. The real shock, of course, was 25% corporation tax, but that's not coming in for a while. And he's reserved the right not to bring it in the event the finances, national finances are better. So let's look at the 2% surcharge in detail. Now, originally, you might have thought this was a tax on Johnny Foreigner coming to these shores. Well, there's one piece of good news in this. It only applies to wholly residential property. So, for example, buying a house with farmland that is being farmed, that is not wholly residential. That is mixed use. And so you don't have to worry about this surcharge, or indeed about residential rates or the 3% surcharge. But it does apply to all non-resident persons. And again, unhelpfully, this piece of legislation has its own definition of non-resident, which nearly but not quite mirrors the income tax test for what's called the statutory residency test. It's actually a lot harsher. So it applies to individuals, partnerships, trusts, companies, including UK companies under certain circumstances, but certain companies are excluded. So how does it work? Well, basically you are non-resident in this country if you are present in this country for less than 183 days in the 365 days up to the day of completion. So if you've taken a particularly long holiday or been locked down abroad, you're probably non-resident for SDLT purposes from the 1st of April this year. Good news is joint married purchasers are both deemed to be resident if one of them has been here. So if you've been locked down abroad, but your spouse or registered civil partner hasn't, then you're okay. You won't pay it. But if you've both been, if you're single or you've both been locked down abroad, then you will. The good news, of course, is that if you've been working overseas because you work for Her Majesty's government as a Crown employee, think Foreign and Commonwealth Office, civil service generally, the armed forces on assignment, then you get a special relief because you work for the Crown. The good news is that for individuals buying their own home, you can recover the 2% surcharge if you can pass the 183-day test in the 2 years bridging completion date. So let me explain. You've returned to the UK, you've only been here for 90 days, you go to buy a house, you have to pay the 2% surcharge because you haven't been resident for 183. But assuming you stay in the UK, as soon as you pass the 183-day test, i.e. 93 days later, you're able to put in a reclaim. And at this point, I should say, it's not 183 continuous days. You could be in and out of the country, provided you can get in under the 183-day rule, or get it in over the 2-year period non-continuously, then you're okay. This has actually generated quite a bit of concern already amongst offshore workers who clearly are outside the UK. It's also potentially going to affect air crew, particularly long-haul civil aircrew, who may well spend more than 6 months of the year in their office at 40,000 feet, assuming that the world allows us to return to air travel. And there are a number of other client groups, so as we call them, that seem to be affected, and they were never the intended target of this legislation. But as ever, it would appear that there are going to be a few innocents that are going to get caught up in this, and we will have to wait and see whether we can lobby Parliament to get them to change it, because I don't think it's at all right that people whose jobs require them to go overseas should be made to pay 2% surcharge, when if the Crown requires its employees to go overseas, then they're allowed to get a relief. And interestingly, the right of refund, as I think I said this earlier, it only exists where you're buying on your own behalf. If you're buying with some other individual, then you've got a problem, because you can't use the 183-day refund test. So who are the other individuals who have no right of refund? Well, it applies to partners in a partnership. It applies to trustees of discretionary trusts and unit trusts, including REITs. It applies to beneficiaries of life interests and bear trusts. So here we have an interesting situation. You may well be a trustee of a discretionary trust. If you spend more than 6 months sunning yourself in the Maldives, then any property purchased by the trust that you are trustee of has to pay an extra 2%. I'm not so sure if you're a professional trustee, your clients are going to thank you. But whereas if you were doing a life interest trust, where the trustees are is irrelevant, it's where the beneficiaries are. So I expect a lot of awkward questions from conveyancers. Well, as we said, this is a non-resident surcharge, so you would kind of expect 2% to apply to non-UK companies, and you'd be right. Surprisingly, it can apply to UK companies if they are close. Close companies test is under the control of 5 or fewer participators. Participators is broadly shareholders, where any of the participators fails the 183-day test and that participator is connected to the others. And I've got a worked example coming up in the next slide. Hopefully I haven't sent you to sleep by now. Luckily, it doesn't apply if you're a registered society, building society, or a company controlled by the Crown, an open-ended investment company, a UK REIT, a member of a group UK REIT, and at what's called a co-ownership authorised contractual scheme, a COAX, that's UK incorporated and managed. And finally, not if you're a financial institution involved in Sharia finance. You look through the Sharia mortgage down to who the borrower beneficiary is. But let's look at this company's question in detail. So let's look at a family investment company, a family property company. A Limited, UK incorporated, buying a UK dwelling. The shares in A Limited are divided amongst 5 shareholders, mother and 4 children. 3 of the children live in the UK. 1, however, has gone off to university in Australia and hasn't been here for more than a year. Well, the company's close. We have 5 or fewer participators. Although the company is incorporated in the UK, it may be non-UK resident if it meets the non-UK control test. And the non-UK control test says if one of the shareholders is non-resident, then any of the other shareholders that are connected to them, family members, the share rights of the UK resident shareholders are apportioned to the non-resident. In other words, a 20% shareholder goes to university and the company is treated as non-UK resident. I'm not at all sure why this was done. This was supposed to stop non-UK residents buying or surcharge non-UK residents buying property in the UK. I'm not sure it was supposed to stop small property companies who have sent one of their children overseas for some reason, or one of their shareholders has retired overseas. I'm not sure if it was supposed to penalise them, but that's what we've ended up with. So what can developers do? Hang on, refreshment coming in. Well, clearly you need to do a lot of pre-deal evaluation, get some advice, look at what your project is, whether you can get release, whether you can use techniques to get on site without triggering substantial performance, maintaining a cash flow advantage while getting on with the job. It's all about the deal. It's all about the project. Look at your reliefs. In terms of site reliefs, it's going to be multiple dwellings relief, but there may be other exemptions which you could apply. Tax efficient vehicles. This is more about corporate ownership for the SME and emergent developer and investor. We see a lot of people operating through SPVs, but those SPVs aren't in a group of companies, and therefore moving assets and indeed sometimes funds around the SPVs, it can be very tax inefficient. The role of a group allows you to move buildings, land between subsidiaries without paying SDLT. And similarly, you don't have to go through a dividend extraction to take profits out of SPVA and use that cash over in the new project company, SPVB. You just simply take the cash up to holding company. Very much more efficient, fewer tax considerations, simpler, believe it or not, from a financial management standpoint. Looking at deal efficiency, timing is everything. Can you get on site without triggering substantial performance? Can you stage site assembly to obtain reliefs? If you're doing site splitting, how can you avoid a double charge? If you're buying non-planning permission land speculatively with a view to getting permission, and I would always argue do that under conditional option, don't do it, but some people do, and you've agreed to sell 50% of the site on to somebody else once you have the permission because they didn't want to share in that risk, how can you do that without incurring a charge when you buy it and a charge to your I'll call it joint venture, not really a joint venture, but you're the person who's joining in on the deal with you? How can you do that without them incurring a second charge? It's possible. You have to use things like declarations of trust, but you can avoid the need for the second charge. And we can do for you, always do a health check on the deal. We would always say get in early, but if you have to, do a review of the deals you've done. Once you've heard today's briefing and say, hang on, could we have got some relief there? Have we missed something? So what are your key pitfalls when you're buying land and buildings without planning? I see a lot of people buying single dwellings as sites for redevelopment. Had one in this morning, a chap buying a house, 1.5 million, plans to flatten it and put 24 flats on. But the trouble is he's paying residential. So how do you step around that problem of residential? Well, first of all, check they are residential. Look for elements on the site that may indicate that there is a property business income on there, such as wayleaves, substations, commercial use, telecoms towers, and any other non-residential activity. That will get you out of the residential. The second is to have the vendor make the house unsuitable for use as a dwelling. Basically, take off the roof, take off the bathrooms, kitchens, toilets, rip out a few floorboards, generally go in there and have a bit of fun. And that will get you, again, if it's not suitable for use as a dwelling on the day of completion, you don't pay the residential or any of the surcharges. And of course, if you're planning to flatten it the day after, your vendor will probably joyfully cooperate in smashing the place up unless he's living in it, in which case he may not. If you're buying land with planning, or you want to buy land speculatively to get planning, most solicitors will recommend a conditional contract. We actually recommend the use of a put and call option. Why? if you exchange a conditional contract, you can't then go on site without triggering the SDLT payment. It's a thing called substantial performance. But if you use an option, you haven't yet exchanged a contract, and you can go on site and start works, do your research, do as much as you want to do within the confines of normal commercial risk. And if you were to do that, you could claim MDR when you finally do exercise the option. I realise that there may be planning issues, but arguably you should be able to improve your position. Mentioned earlier, the idea of permitted development conversion, sometimes referred to as build to rent or convert to rent, and multiple dwellings relief. There's been a number of articles on this, but typical example here, property developer acquires an office, permitted development, converts it into 31 residential apartments, pays 2 million and started the works. Paid SDLT of 90,000. In fact, because of the PD right, multiple dwellings relief was available on the day he bought it, and the liability should only have been 60,000, and we got £30,000 back. Well, the why is obvious. You calculate MDR, but dwellings, for the purposes of multiple dwellings relief, actually has a different definition to residential land when we're talking about residential versus mixed use. And it includes dwellings that are under construction or adaptation. Adaptation includes strip out. Now, I'm not yet to meet a commercial building where the current owners haven't already stripped something out of it. So generally speaking, you can, with a bit of photographic examination, you can generally find that there has been some strip out, which means you can claim multiple dwellings, or you could go back and revise your returns and now claim it. And so you would actually calculate your SDLT, divide the 2 million by 31 apartments, calculate the SDLT on 64,500. That would be a 3% minimum rate, because this was a wholly residential development when finished. Multiply that 1,935 up by 31 back to 60,000, and you can see the difference. Interestingly, if this development had included any element of commercial space, for example, a coffee shop or a shop on the ground floor, then the SDLT would have been 20,000. It would have fallen to the 1% minimum rate that you get for mixed use developments. So this refers to the remark we made in the opening slide. So sometimes you have to calculate the SDLT 3 or 4 different ways on a deal, and then pick the one that fits. Even in the most straightforward cases, you may have to do the calculation 3 ways, and then you're allowed to choose the best result. That's actually in HMRC's guidance. So to summarize, what are the top 5 areas of concern? Well, multiple dwellings relief, and are you claiming it? Mixing it up, are you looking, or are you establishing whether or not you've got mixed use? Are you looking at habitability, particularly when you're buying a house in just to flatten it and replace it with flats? Are you making sure that you're not in danger of triggering substantial performance by the use of options, not conditional contracts? And lastly, have you considered the 49 reliefs? When I used to lecture prior to lockdown on SDLT for central law training, we used to do a pop quiz. And we used to ask the room full of, well, not surprisingly, lawyers and legal staff, how many reliefs they thought there were for SDLT. Interestingly, 70 to 80% of the room thought that there were fewer than 10 reliefs for SDLT. What that means is that there's a 4 in 5 chance that your solicitor has missed something, that your solicitor hasn't considered a relief that might apply. So how do you recover from that position? How do you climb out of the pit? Well, you've got up to 12 months to make a claim in most circumstances. Some MDR, for example, you've got up to 4 years. With certain connected party transactions, you could have up to 17 years. But I would still say you don't have the luxury of time to wait. You need to think about your deals and act now. Do a review. It costs half an hour of your time and none of your money, just to check out a few basic facts and establish whether or not a refund might be possible. In the investor and private client space, again, looking at all the applicable reliefs, looking at in change of legal state, we've had a lot of incorporation going on in the private rental sector. Still solicitors I see telling me, oh, it's an incorporation, it has to be market value. That isn't the case if it's a partnership. I mean, public awareness and professional awareness of this has grown a lot over the last few years. But still to this day, I hear lawyers saying, no, that surely can't be right because the result is nil. It is right. What is worrying is it's not just transactions with partnerships and companies that are affected. It's actually transactions with anything that's connected to the partnership. So it could be an individual, could be a company, could be a trust, could be a pension scheme. And generally, if there's a 100% connection, there's 100% no tax. And it's a wonderful little thing, particularly because it's an anti-avoidance provision. So the revenue would have to argue that their anti-avoidance provision doesn't apply. Now, in the 14 years that I've been doing this, we've always done these with revenue agreement, and we've never had them come back afterwards. So it's as good as it gets. I would go back to say as safe as houses, but you know what I'm saying. It's as good as it gets in the current environment. You just have to make sure there's more than one individual involved. And most solicitors have said miss it. Now, the suitability for use as a dwelling, and I don't want to spend too much time on this, just to emphasize the rate falls to 5 from as much as 17. By the way, that's not my house, nor is it the one in the Bewley case, but the property has to be not suitable for use as a dwelling. The Bewley case is the lead on this one. Their house was actually made of asbestos. Probably not something you'd want to go and live in. It also had a lot of other things missing, like central heating, floorboards, glass in the windows, you know, these minor things that make life worth living. Generally, bathroom, kitchen and toilets are a minimum for suitability for human habitation. That's based on the Housing Act 1957. Helpfully, the Human Habitation Act 2018, which was a private member's bill to stop nasty landlords putting tenants into unsuitable properties, extended the list of factors which can make a property unsuitable for use as a dwelling. And this includes damp, mold, unsafe electrics, lack of heating. So generally speaking, we take the view that if you couldn't let a property because of the Human Habitation Act 2018, it's not suitable for use as a dwelling. And that gives you the benefit of the non-residential rate and takes you out of the surcharges. Similarly, mixed use will do this. Most dwellings are a residential property, but only if 100%. So if you have any commercial activity on the land, farming, horticulture, even hobby horticulture, woodlands, equestrian activities, grazing licenses, agricultural leases. If you have commercial buildings on the site, if a building on the site has been used commercially, for example, you're buying your next house from a chap who was a furniture maker or a carpenter, cabinet maker, and he used to make his cabinetry in the garage. The fact that it's a garage is not directly relevant. The fact that it was used for a trade is what's relevant, and that would give you mixed use. Looked at a very expensive property the other day, and unusually, even for a property of that value, it had 8 garages. And when I raised the question, they says, oh, yes, that's where the current owner used to run his motor racing team from. Well, you can imagine, happy smile on my client's face. I went, well, we've got commercial use then. You can get mixed use. Look for rents, licenses and way leaves. They're called property business income. If you've got property business income, somebody's paying you for a pylon or a pipeline or a substation on your land, the revenue regard that as taxable income, and therefore you will not have a wholly residential property. And again, you should be able to claim mixed use. Again, looking at traditional or habitual use of the land, this is really saying what you're going to use it for is not relevant. What did the vendor use or currently using or had used it for? looking for small elements of trade. And here I would say not use of home as office, but any real trades that actually involve storage of goods, work on materials, those sort of things, small garage, mechanic, anything like that, that will get you over the line into mixed use and be valuable. You have to establish the true relationship of the land to the building, in summary. But your SDLT, again, falls down to that 5% rate from potentially 17. That's incredibly valuable. We have other reliefs, as I said. We have one, my particular favorite in the built environment space is house builders or property traders buying from personal representatives. Thankfully less topical than I thought this was going to be 12 months ago. Buying part exchange properties for people buying new homes from house builders. Both house builders and property traders can get this one. Stepping in to restore a broken chain break for property traders, where they go in where somebody's lost their buyer and the chain is in danger of collapse. Out buying where employees are relocating their employment. Not been very popular in the last 12 months, this one. You can understand why, but it may be in the future. But the interesting part about this is that in all of these cases, it's a 100% relief from SDLT. Most solicitors don't know about these. And if you are planning to trade a property, you really want to make yourself familiar with these, because as you can see from the list, a lot of these depend on the status of the vendor. So you're going to have to get a statement from the vendor. Well, the personal representatives one's fairly obvious, but in the others, you know, I am buying a new home from a house builder. Oh, great, I can claim my relief then. In terms of numbers, well, we've recovered over £12 million from HMRC in the last 12 months. In fact, we've got busier during lockdown. You need to remember what we've been saying. You've probably heard me say this. You can go from 17% right the way down to nil under the right circumstances. My favorite number, how much we charge. We only ever charge 25%. If we do a pre-completion, we will charge you 25% of what the positive impact our advisors had on your liability. If we do a refund, it's 25% of the reclaim when we get the reclaim. Both sides fully covered on our PI. How it works, or how we work, you can call us at any time for a review of a deal pre or post completion at our website, or websites I should say. You can email us on this email address. You can call us on that number. And to be honest, that's all I've got to say. So back to you, Matt.
Oh, thanks very much, David. I think I'm here taking all kinds of notes. You know, maybe a new career awaits me. And when I come for one of your pop quizzes, I'll know that there's 49 different SDLT reliefs. So.
I mean, I will tell you in the audience, it was quite funny because when I used to lecture, I used to say, did you know there are 43? And then one day I downloaded the index of reliefs from the revenue manual, went, bollocks, it's 49. Even there were 6 I'd forgotten about. Not that I memorize them. I'm not that kind of anorak. But, you know, it was genuinely surprising. I mean, some of them are really, you know, housing associations. RHAs get a certain relief. You've got what's called enfranchisement relief. That, by the way, it's not buying a McDonald's or a KFC. That's when tenants buy out. I actually had an inspector of taxes who thought that's what it meant.
Right. Well, people are in the right hands, and I think that many of us would get behind voting for you for Chancellor of the Exchequer if you ever were going into the political realm. So.
Oh, I think Rishi's got that job for the next 25 years.
We'll see. Obviously, this is the time for people to start throwing questions into the main stage chat. I've had a few privately messaged me. I'm not sure why, but I can't.
They don't want to be identified.
Yeah, I can't answer them, and if I do answer them, then I'll take the 25% instead. So anyway, I'm going to kick off. I'm going to kick off, David. I've got a developer here who's written to me. There's no name on the developer, but thanks very much, Steve, for sending this question. And it's as a property developer, typically paying 5% stamp duty for commercial to residential conversion, are you saying that I should definitely be claiming reliefs?
Yeah, you should. You certainly should be looking at whether you can claim multiple dwellings relief on the acquisitions. It's a long and established road now, but it's not very widely known. I mean, we've been doing advisory and refunds on this since 2016. And when the revenue changed their guidance and climbed down on the minimum rate from 3% to 1% November last year, we had a rush of people doing reviews, and we've had numbers back that vary from 30,000 to 400,000 because of this missed relief.
Right, not a significant chunk, not an insignificant chunk of change, that is it. So yeah, I'd advise you.
I had one client walk through the door the other week. I'm obviously not going to name them, but they'd done 3 deals in 3 years, and the total overpayment was 3.3 million.
Right. Okay.
Ouch. Well,
yeah.
Not ouch. We're going to get it back for him, but.
Yeah, so everyone needs to get in touch with James or David if for anything to do with this, because obviously they can do you some good. I've got another question here from Sally, and it says the 2% surcharge appears to be a bit of a nightmare. We're a property development company with an executive chairman who spends much of his time overseas. Is that an additional 2% stamp on our deals?
The answer is not just because he's overseas. The question is, how many shares does your chairman own? How is he connected to the other shareholders? Are you close? And you've got to go through all that benchmarking that before you can establish that. But certainly you're on notice. You need to think about it. I've even seen one example where a PLC was made liable, which was bizarre. But there you go.
Okay, I've got one coming in here now from in the chat. It's starting to liven up a little bit. Natasha Rose of ERC Consultants. Should we have a progressive capital gains tax on vendors as opposed to purchasers? Purchasers would be motivated more and vendors resigned to tax on sites to realise capital growth made. As you can see in the chat there, if you want to reread that question from Natasha.
Hey, I'm only here to do stamp duty. Where are we? Main stage. Sorry, Natasha. Apologies. We did try this actually. In the 1970s in this country, they introduced a tax called Development Land Tax, DLT. Sounds very familiar, like SDLT, doesn't it? No, but it was DLT. And the idea was that they taxed development gains, to punish these greedy, rich developers. It had 2 effects. One, it completely strangled house building in this country almost overnight, and it stopped land being released for house building. So I think a progressive capital gains tax may have exactly the opposite effect that the government wants, which is more house building in this country. I don't think at the moment that in the economic state we would have, I don't think the government would want to do anything that would cause yet another industry to enter a prolonged slump. So, but in principle, should we have a profits tax on development? Again, I said DLT in the 70s didn't work. It just made a lot of money for chartered surveyors and tax barristers arguing about, because it was all based on valuations as well. It was so hypothetical. That it made a lot of work for chartered surveyors and tax barristers, and very little money for the government, actually, in the end.
Thanks very much for that, Natasha. I've got Carol Lee here who says that was a very useful presentation, so thank you, David. Please, can you clarify what you mean by probate traders?
So I'm going to have to improve my screen resolution or get more glasses. Property traders, sorry, not probate. Property traders buying from personal representatives. A property trader is a company established for the purpose of trading in properties, funnily enough, but it's generally a limited company. You can't do it as a partnership or an LLP. You have to be a company. But beyond that, as long as you buy and sell properties, you qualify for the relief.
Okay, and we've got Nick here, who's Nick Stevens. Thanks for writing in. David, what are your thoughts on a land value tax to replace stamp duty to disincentivize poor use of land versus disincentivizing transactions?
I've not seen the proposal in detail. The idea that the problem you're going to have again is how are you going to measure poor use of land? Is this going to be a subjective measure? I'm an opponent of wealth tax. There's a lot of people calling out during lockdowns 1, 2, and where are we now? Oh yeah, we're in 3 now. I lose track. But wealth taxes ultimately seek to tax asset value without taking account of the cash flow position of the very people they're taxing. I've met some very wealthy people in Kensington and Chelsea who are actually living off their state pension. They happen to have bought the house in 1949 and have been there ever since. But actually, they're cash poor. So you've got asset rich, cash poor. If you're going to try and levy an annual wealth tax on people, but they can't borrow, how do you collect it? And these are all great principles. I mean, I was one of the few people who, during lockdown 2, when we were debating the state of the economy and how we were going to get out of it, I think I proposed a digital sales tax. I said, to me, we've lost VAT receipts, fuel duty receipts. We've lost so many of what I call the traditional taxes. Maybe we should look at a DST on internet sales, because that's clearly where all the economic activity has gone. And I know that the Treasury are looking at it, but they're waiting for, there's a global organization or a global meeting to decide whether it's going to be a global tax.
Yeah, we've had a few comments on a lot of our webinars around economic growth, around kind of getting things off the ground again, building back better, and who are the companies that should foot the bill for that, and is it morally and ethically right for companies who've performed well due to the situation to funding it? But there's always going to be several different opinions on this, isn't there? And you're never going to be able to please everyone when it comes to that kind of. No,
absolutely not. I mean, we're kind of straying into the era of economics and tax policy, but I keep seeing all these doom and gloom stories, as though Great Britain was solely built off coffee shops and hotels and restaurants, and it's not true. And I'd be interested actually in hearing the audience's views. But everybody we've asked in the last 6 months, and we've not been asking big businesses, been asking everything from a jobbing builder right the way through to shop fitting companies and all kinds of companies. How's this year been? And they've all gone, great. Now, how does that jibe with the headlines? I don't get it. But I know these guys aren't lying to me. So we have a tendency to, well, put it this way. We have a tendency to believe the news, but journalists don't get paid for telling good news stories, do they?
No, it's all about clickbait nowadays, isn't it? How many people get through a story? Yeah, I agree. I've got a question here from Mark James at H&N Project Services, and that is, should stamp duty be split between the purchaser and the vendor rather than just be levied on the purchaser?
Is it going to make any difference? I mean, I've seen people say put it on the seller. Well, the seller's just going to cost it in. Ultimately,
yeah. I mean, put the price of the house up. I see.
Yeah. Well, you saw what happened with the stamp duty holiday. The price of nearly every house went up 15,000 overnight, costing in the saving. How you split the bill, in my view, ultimately doesn't affect the metric of the tax collected. I'm a great believer. I'm a libertarian at heart, so. I was the one who was calling for the nil rate ban to be raised for 300,000 permanently, which Rishi didn't get that memo from me, because I think we need to liberate that. If you look at it, I think it's 86% of all transactions yield less than 8% of all tax, and they're all below 300. Now, wouldn't it be lovely just to say if you're below 300, no tax? And I don't think it would cost the government that much, to be honest with you. Probably a lot less than the SDLT holidays cost them, but it would mean starter homes, first time buyers, what we call I call new entrant homes, because they may not necessarily be starters, but new entrant homes. That would be brilliant. I mean, everybody would go, well, I can go and buy my first house and pay no stamp duty. It is fantastic, and that would get everybody onto the property ladder, which is what we want, isn't it?
Well, that's what's being said, isn't it? Was it generation rent to generation buy that they're trying to push at the moment on the front bench of the government? So that kind of leads you to a question that might be quite entertaining to answer, I suppose. So, And honestly, I always enjoy, chatting and hearing from you anyway. But so what is HMRC's attitude to receiving such claims for these repayments that you're asking? Is it something they collaborate on, or do they make it difficult?
No, in general, most claims come through in about 4 to 6 weeks. You get occasional ones where they'll raise a question and ask for more documents, and you just send them. We actually, our refunds team actually has a fortnightly conference call with their refunds team to check out case progress. And it's like, if we see one that's, should we say, falling behind the herd, we'll say, what about this one? Oh, yeah, sorry about that. That chap's been off, or they're collegial, cooperative, yes. Happy about it? Probably not. But, who would be? But yeah, and there's no rhyme or reason. It's not the size of the claim that causes the delay. We had a 1.3 million reclaim that went round the bike in 21 days. We couldn't believe they got that one back to us that fast. And yet we had a £40,000 one that we chased for 11 and a half months.
Yeah, I suppose it's project officers that you're dealing with and how fast they can get through the caseload.
Yeah, I mean, look, but let's be realistic. These guys, they're doing a job, they're paid to do a job, but they're not incentivized to, they're not looking for 5-star Trustpilot reviews like my team. It's they just do the job.
Maybe that's a sideline business that we can set up a kind of a trip advisor for local authorities, public sector services.
Now, there's an interesting thought. If you were actually to sign up, create HMRC's Trustpilot account, I wonder what star rating they get.
Yeah, exactly. I've got a question here that's literally just come into my inbox while you were talking. We've got a rather shy Scotsman on, and they've basically said, "What about Scotland? Does this apply to me?"
Yeah, it does. I mean, the LBTT legislation is broadly very similar. I mean, the thresholds are lower, the rates are different, but it has strong similarities. I would recommend, again, the reliefs are all there online on Revenue Scotland's website. If you just have a look at it, and if you think, oh, that probably would have applied to me, again, call us. We'll have a look at it. We'll go run through it with you, and if we think there's something there, we'll tell you. If we think there isn't, we'll tell you as well.
So you mentioned something a couple of minutes ago that I wanted to pick up on about, your team being able to have, fortnightly calls with HMRC. I suppose our audience would be quite interested to know if that's typical of other organisations. We don't want to talk about competitors here as well. But is this something that's just brilliant business development from Cornerstone, or
I think it was. It was. I think what happened was that the teams were experiencing so many delays that I think we suggested to them. I seem to recall that, yeah, guys, would you like to have a fortnightly conference call? We can just unbung any kinks in the hose, and they thought that was a good idea, so we do it. I don't know whether anybody else does it, but yeah. It's logical, and if a piece of paper's gone down the back of somebody's filing cabinet or been blown out of their in tray, or in the days of home working, and even the revenue are working from home, if the cat's eaten it, they won't know.
Yeah.
If you're in the moment and go, I posted this 2 weeks ago under this, oh God, yes, here it is on my post log. No, I can't seem to find it. Right, leave it with me. Send it in by email. We'll sort it. So, and that's the other thing with COVID, is that they've become much more receptive to the idea of electronic document transfer and stuff like that. So much so that we no longer need what are called wet signatures, ink signatures on forms of authority. They'll accept electronically signed forms of authority now and stuff like that. So, in some respects, the pandemic has, shall we call it, smoothed out and speeded up processing with government, and they're now more open to electronic means than they were before.
And I think that's the same with a lot of what you'd call public sector organisations. If you even just go to the doctors now, a lot of records are finally getting digitalised and much easier to deal with. So yeah, it's good to know that the sector's working alongside central government.
It's largely been. I mean, it's completely outside the ambit of stamp duty. But I saw the other day that they've during pandemic, they couldn't accept form IHT 400 forms from personal representatives because they insisted it had to have a wet signature. And it took them a few months, but eventually they got the systems in place to say, oh, we will now accept them with electronic signature. And they've just announced that post-pandemic, they're not going back to it. They're sticking with electronic signature, which is great now because it's just one less thing that you have to worry about when you're doing your IHT 400s.
Yes, it is. And I think it's, fair to say that I've really enjoyed listening, to everything that you've got to say. And our Built Environment Networking will vouch that, Cornerstone are an organisation that you should be talking to if you're developing, buying, or having anything to do with property transactions across the UK. We really enjoy these informative sessions. So I just want to say thank you, David.
No, you're very welcome, Matt.
And I understand that you and your team, James, etc., will be over in the networking lounges. I'm sure some of these people who've asked questions are going to come and, try and collar you and take up some of your time. We will be doing future events similar to this with Cornerstone. So just want to say thanks very much, David. And we look forward to seeing you again at one of our events. And I suppose with that, we can talk about a few future events that may be related to, not just the tax, but all kinds of risk associated with the built environment. So we have a pretty major construction insurance and risk conference on Thursday, the 1st of April. That's April Fool's Day for all of you out there. And that's 9:30 till 1 o'clock online. We have some top quality speakers coming along to talk and to inform our audience of all the pitfalls and challenges that are, faced by organisations when it comes to insurance and risk. Aside from that, I'll just go back. We have all kinds of other events. Just this afternoon, we have a fantastic event looking at construction technology and mobile platforms and the role that mobile platforms are playing in the development and construction sector. One of the most popular events of the month, with over 400 people now booked onto it, is the Green Infrastructure, Make It the Heart of Smart and Future Cities and New Development, which takes place on Monday, totally free of charge. You can book on to that via our website. We also have 3 absolutely fantastic sheds and logistics property developers coming to unfurl their future development pipelines for us on Monday lunchtime. And then we also have another free of charge event on Monday afternoon, which is the challenges of delivering major infrastructure projects. Aside from that, if procurement and wanting to win work and frameworks is your bag, we have the sequel to our hugely successful construction procurement and frameworks event, which took place back in early February. This time we're going up to Scotland, and we have speakers from the NHS, Scottish Government, various councils such as Glasgow, Scotland Excel, all coming to talk about their future framework and procurement processes and launching new bids of work. So that is on Tuesday, the 30th of March. The water sector is really popular at the moment amongst the Built Environment Network. And we have a session on future-proofing future water infrastructure. And if the political sphere is your bag, if you go on our website, you will find that we're hosting Q&As with pretty much every single mayoral candidate from every single combined authority for the elections that are coming up on the 6th of May. These events are totally free of charge, and we've arranged it so you are going to be able to meet with the candidates and actually be very candid with them and ask questions. The first one is the 19th of April, the first day back after Easter. It's with the candidates of Cambridgeshire and Peterborough. The current incumbent, James Palmer, is joining us. We've got Nick from the Labour Party, who is the challenger, and we've also got Aidan from the Liberal Democrats, who's also a challenger, taking part in that. And if you are one of David's overseas expats, living the life of Riley out in the UAE or whatever, you may be interested to learn about the property and construction market and everything that's happening out there at the moment. It's a very much a thought leadership-led event, and that takes place on Monday, the 19th of April as well. Tickets for all of those and much more are available now by visiting our website, the same link that you used to book this event. Finally, we have a major announcement to make, which is we will be creating a completely new forum for developers, investors, public sector and end users to get together and hopefully start some collaboration as part of the Build Back Better initiative. UK REIF, which is the UK Real Estate Investment and Infrastructure Forum, is taking place in Leeds between the 17th and the 19th of May 2022. We have an advisory board which is chaired by Lord Bob Kerslake of the UK 27 Commission. We are supported by organisations such as First Base, Capital and Centric, MEPC, Scarborough Group International, Manchester City Council, and a whole host of other major bodies. Kate Willard at the Thames Estuary Growth Board are all supporting our event. We have had such a positive response to this. There are tickets available now at super early bird rate to join a whole host of really important property, construction and infrastructure dignitaries in Leeds next May. Other things that we can do, if you're listening to this and think, I wouldn't mind a bit of that, I wouldn't mind to try and emanate what David has done this afternoon, we can actually do that for you. You can contact my colleague, Famida Nisa, or my other colleague, Mike, if you've got some market research that you'd like us to conduct. Mike's the man to do that. We have an entire research team now working on projects for clients. We are running bespoke events like this one for Cornerstone with many other organisations. The Green Infrastructure event, which takes place on Monday next week, focused around making it, an integral part of future cities. That is with an organisation called Logica, who have commissioned us to run that event for them. And we've got over 400 people coming along to meet Logica, learn about their services, but also learn about some of their clients as well. And with that, before we close the broadcast down, I want to say thank you yet again to the fantastic team at Cornerstone and also to our partners. That's Wilmot Dixon, who are our national partner. And then we've got Newformer, View City, Barber ABI, Mail Manager, Butler & Young, Langley Roofing Systems, Lead Associates, CLS Risk Solutions, Pagabro, Cypro, SPC, and of course the Public Sector Framework Database. That's it from me, apart from I'm pulling double duty, and I'll be back with the Mobile Platforms event in about an hour's time. But please head over to the networking lounge immediately and chat with my team and David's team. And we look forward to seeing you all yet again on a built environment networking event, which will be taking place pretty much. We have events on every day between now and the end of the year. So thanks very much and see you later.